Hi, good afternoon, everybody. My name is Dale Franklin, and welcome to Essentials. It's lovely to see you here, and it's lovely to see you here for a slightly different subject. Normally, when financial advisors hear the word Africa, they run a mile. So thank you for some lateral thinking and being open to it. Certainly, I think that hopefully we can change your mind and give you a whole new world of possibilities. Today presenting is Nolan Wapenaar. He's our co-CIO and head of fixed income. Nolan has possibly the longest track record of running Africa income in South Africa. He certainly started the first African income unit trust. Alongside Nolan is Casey Delport, who's our economist, who will also be sharing the mic with Nolan. So if you do have a question, if you could please type it into the chat function, and I'll get to as many as we can at the end. CPDs will be sent from this event as soon as we receive them. So without further ado, I'd like to introduce Nolan.
Thank you very much, Dale. And hello, everyone. Thank you for dialing in to hear me chat again. Thank you for dialing into Essentials. And, as Dale says, Africa is a topic that most people tend to run a million miles from. So it's actually, maybe I'm preaching to the converted, but I do appreciate an opportunity to chat about Africa. So certainly something that's close to my heart these days. And talking about Africa, I think the starting point for the discussion is actually talking about the rest of the world first. Specifically, what I've got up in front of you is our asset allocation chart from Anchor's quarterly sort of asset allocation review and our views on different asset classes. We publish this quarterly. We held a webinar on it 2 weeks ago, I guess. And the point I want to make, though, is each quarter we put out our view on, what the opportunity set is within different asset classes. And one of the trends that we've noticed, one of the trends we're picking up on is that, it's been a great ride to where we're at, but the future is potentially less rosy, and, the outlook is less rosy. So, returns are probably going to slow down across asset classes. We're still in a good risk environment. We still like risk assets, but we've got to be realistic. Risk assets generated 50% last year, maybe 30% this year. Next year is going to be more normalized, more pedestrian. And as returns are slowing down and probably will continue to slow down, we need to start looking a little bit further afield, start looking at some alternative ideas to say, where else can we generate returns that are actually within acceptable risk bounds? And it's in that context that I want to talk about Africa, because we do think that there is space for Africa within everybody's portfolios. Well, about 3 or 4 months ago, I actually Googled an interesting question of, why invest in emerging markets? And lovely quote from the Wall Street Journal was that the biggest advantage to emerging markets is the stronger or potential for stronger economic growth. And this has been, something that's come through. So if you look at the world's regions, obviously China continues to be a rapidly growing region. Economically, India has been doing reasonably well, and then by and large you've seen some significant economic growth rates in Africa as well. Economic growth rates up 7-8% in places. So a consequence of this was that a couple of years ago, a number of people, a number of investors looked at this and said, I've got to access some of the African economic growth, and they invested in African equity. And by and large, to be honest, has ended in tears for a variety of reasons. And the people who invested in equity then came out of Africa with a bit of a sort of poor outlook, poor view on Africa, for lack of a better phrase. And the first response that you get when you talk about Africa is that the returns are just not worth it. In other words, the returns are mediocre. The second myth that then comes up is these people found that when they wanted to exit their equity positions, it was actually quite difficult, and then liquidity is a problem. Again, that's a myth. And thirdly, the perspective is that the risks are unacceptable, particularly the credit risks in Africa. I want to actually use the next hour of my time, or the next few minutes of my time, to unpack each of these myths, to talk about our perspectives on Africa, why this isn't the case, and why there really is a good opportunity within African income. So, starting to look at African income, let's define what that means to us, because it means a lot of different things to different people. Very busy slide, don't need to read all of it. But in essence, the question is, what do you invest in? Because that really is what drives your risk and your returns. And I can invest in very risky fixed income in South Africa. I can invest in very risky fixed income in America or in Africa. Conversely, though, I can actually invest in very conservative fixed income. How conservative? If I wanted to, I could get you an international scale AAA rated portfolio of African income, and that actually carries a better credit rating from the rating agencies than the United States of America does, to be honest. S&P's got them as AA. So it is, it's all about what you invest in. And I think that's the key takeaway. In terms of how do we look at Africa, we're actually very, very strict in terms of what we think is investable within Africa, because you don't want to get tripped up on all of these potential snags. So the first point is that when investing in frontier markets and emerging markets, what you really want to do is focus on the hard currency investments. Don't go and invest in local currency in Uganda or Kenya or whatever, Nigeria. Just buy hard currency assets, invest in US dollars. That takes away a lot of the currency risk. It takes away a lot of your liquidity risk, gives you a great comfort that your investments are actually, firstly, hard currency invested, and secondly, that, the value of the investments is more readily obtainable. Secondly, when we invest with these countries, what we're looking to do is lend money to these countries in what's termed technical jargon as Eurobonds. But essentially what this is it is a hard currency denominated bond issued by a government, and the bond trades in the USA or it trades in Europe. So it's pretty much a European issued bond issued by one of these countries denominated in dollars. Pretty much like the government of South Africa goes from time to time and issues Eurobonds, denominated in hard currency to fund itself instead of relying just on the domestic markets. So this is where the sweet spot is. This is where the opportunity is. And the reason for that is that you're able to earn quite an attractive credit premium for lending money to African countries, which actually means that in a world where interest rates are trending towards zero, you're able to actually lock in decent hard currency returns, which manifests itself over time as a good outcome for investors. Get back to that in a bit, but I just want you to bear in mind loosely what we're investing in. So how's it done? Think about that myth. The returns aren't worth it. So what I've done is taken the annualized 3-year returns and then the returns since we started our fund, which is 2013, and for different asset classes. So I've tried to take just sector averages wherever I could to say how has African income actually fared. The star performer over the last 3 years, and in fact, the star performer since 2013 is global equity. I think it's been an absolutely phenomenal run, and it's been a must-have in portfolios. But interestingly, when you look at asset class performances, the second best performing asset class has actually been African income. It's outperformed domestic equity. It's outperformed domestic fixed income. It's outperformed domestic bonds. And as a result, it actually has generated for investors that were invested over the time a good outcome. And that's the point, is that, I know a lot of investors previously looked at African equity. African equity returns have been somewhat lower, but in rand terms, African fixed income has certainly delivered in line with expectations. So from that perspective, the myth that the returns aren't with it, Actually, over long periods of time, over different periods of time, the asset class has certainly added value to those who have been invested. The second myth that we keep coming up against and keep talking about is liquidity. So what happened with the equity investors is they'd all buy Nigerian shares, they'd sell the shares on the Nigerian exchange when they wanted to exit, and then they'd find out that to take Nigerian naira and convert it back into US dollars, there's a 6 to 12 month waiting period. There's a queue of people who want to get out of Nigeria ahead of you, and actually getting your money back is a problem. The shares themselves, liquidity is less of an issue. It's actually the local currencies. But that's okay. Remember, we said that we're investing directly in US dollar assets. So when we sell these bonds, we sell them over the London Stock Exchange or Luxembourg Stock Exchange, for example, actually we get paid dollars by whoever bought them from us. So we don't have that currency conversion issue that has created much of this illiquidity that people talk about. And in fact, what I've got in front of you are market impact analyses from Bloomberg. And if I pick the first one, top left, what you see is Morocco, you can kind of go down the volume here, but you can see the daily volume in this particular bond, the Morocco 2022 bond, so it's a 1 year to maturity bond, is about $13 million per day for this bond. Interestingly, if I go across to the right, a Nigerian bond maturing in 2027, the daily volume is about $25 million. Put that into context, $25 million in Nigerian bonds is roughly 325 million Rand of these bonds trade every day on average. The brutal truth is that if you own a domestic flexible income or core income type portfolio, and it's invested in bonds issued by First Rand Bank, by bonds issued by Growth Point, it's invested in Discovery bonds, wherever it might be invested, those particular bonds do not trade in these sorts of volumes. And in fact, what you will find is that the Nigerian 27s or the Morocco 22s or the other bonds on this table are significantly more liquid than any of the bonds that trade in the domestic South African bond exchange. So where you come out is actually these bonds are more liquid than most of the other fixed income holdings in your client's current portfolios, which again is a bit of a sort of mindset change, a bit of a shift. So from that perspective, look, investing in Africa, there are a lot of things you've got to be aware of, you've got to be cautious of. But ironically, we find that liquidity risk is less in African fixed income than it is in the domestic fixed income markets. But perhaps the most important aspect, and where we're going to spend most of our time today, is on what is really going on in Africa. What are the risks in Africa, and how can I lend money to Rwanda or the Ivory Coast and have some confidence and comfort in the credit risk that we're running? So I want to spend a bit more time talking about developments in Africa, how Africa has been evolving. I'm going to hand over to Casey in a few minutes, just to give us her perspectives as well. But the point on Africa is that Africa is a diverse continent, 52 different countries, and actually the countries behave very, very differently. So what I've got here as a chart on the left-hand side is a chart that Moody's put out, one of the rating agencies put out. And basically what they did is they said, look, coming out of COVID, one of the consequences of COVID and the lockdowns was that all countries accumulated significantly more debt very rapidly. South Africans' debt levels increased by 10%. And to be honest, across the board, that's about what most countries saw. The thing is that you needed to adjust to this. You need to adjust to the additional debt. You need to look at making your debt sustainable. And there's a fiscal adjustment that needs to take place. So what Moody's did is it went and looked at all of the countries and it said, let's look at where your primary balance, in other words, is your government running a deficit or a surplus is at the moment, and let's look at where it needs to be to stabilize your debt. So if you're running a deficit of 3%, but actually to stabilize debt, you need a surplus of 1%. They're going to say you're 4% off where you need to be. And I said, let's chart that. So if I look at the chart on the left-hand side here, what you will see is this blue dot that kind of comes down. And the blue dot is basically saying where are people relative to where they need to be to recover from COVID. And if the blue dot is positive, basically it means that your government revenue exceeds what it needs to be, and your debt is going to stabilize, your debt is going to come down, and actually your country is in a reasonably good shape. And as you move along, you can kind of see the countries that have, the highest surpluses, i.e. they're paying down debt the fastest. A lot of countries are kind of chugging along. And then you can see the countries that have basically got a debt problem. In other words, countries that have not been able to make the fiscal adjustments. And ironically, if you look at which countries Moody's thinks are the ones who still, unable to adjust to to the new world, unable to actually put their debt in a sustainable place. South Africa and Eswatini, Swaziland, right on the right-hand side there. So from that perspective, what Moody's really is saying to us is that a number of African countries have actually adjusted. They've undertaken the necessary difficult decisions, reduced subsidies, managed their wage bills, etc. And the countries that have so far been unable to do it or have just not done it are really South Africa and Eswatini. Where do you want to be invested in Africa? Do you really want all of your clients' fixed income sitting just on the right-hand side there? Looking across at the other chart that Moody's has provided us on the right-hand side, what they have done is ranked the flexibility of different countries' budgets. In other words, as a country earns more revenue, it's able to spend a little bit more. But how able are they? How flexible is it that if revenue starts to decline, that the country can switch off its spending and actually, adjust expenditure downward? And again, South Africa is one of the least flexible countries in Africa. So our government expenditure is very, very rigid. A lot of it's basically either wages or interest expense at this stage. And as a consequence, it makes it very difficult for our government to actually adjust the budget as the economic cycle shifts. The countries on the left-hand side, though, were the countries with the most flexibility. For instance, Cote d'Ivoire, Ivory Coast, third from the left, are the countries that have this massive ability to actually manage their budget dynamically, to actually adjust to the environment they're in, and therefore provide far more attractive investment opportunities potentially in the longer run. As I said, Africa is not a homogeneous state. It's actually 52 different countries, all of which have very different outlooks. And what I've got here is a map of Africa, and it's sort of colored by our perspective on, where the good opportunities are in Africa, where we're more concerned. Certainly there are problem children in Africa. Naive to believe that there won't be. Zambia is a problem child. Mozambique is a problem child. Congo and the Seychelles, ironically, are the key problem children. The countries that I have highlighted are only the only countries that issue Eurobonds. So they're kind of the investable Africa, if you want. But interestingly, you have a number of countries that are actually also quite attractive, that are screening very attractively. We put South Africa in there mainly because of its size. I think South Africa is still one of the more investable destinations in Africa. But it ranks right up there with the Ivory Coast, with Senegal, with Egypt, Morocco, etc. And if anything, Casey will chat about it in a few minutes, what you will see is that the trend in a lot of these countries is for improvement, whereas South Africa is actually still fighting to turn the tide, and it's debatable as to whether we're seeing structural improvement. But with that in mind, what I'm going to ask is for Casey just to hop on for a few seconds and to chat about the Ivory Coast, just to give you a perspective of another African country, one that's actually been doing quite well, and how they've handled the COVID crisis, how they've come out of it, and how following the COVID crisis, they've actually been seeing credit rating upgrades, notwithstanding the fact that they had to work their way through a crisis. Casey.
All right. So yes, as Nolan mentioned, the Ivory Coast is actually a great example of a country that not only came through the COVID-19 pandemic strongly, but there's actually a good argument to be made that the Ivory Coast is now in a better position than actually before. But, in order to understand that, we first need to just take a look at where the Ivory Coast was before the pandemic actually hit. And what we really saw was a decade of robust macroeconomic performance that has offered the Ivory Coast strong resilience before the pandemic. So if you look at the graph there to your left, which plots out the Ivory Coast real GDP growth percentages, you can see that from 2012 onwards, the Ivory Coast has continually posted strong growth rates well above the sub-Saharan African average. In fact, it's actually sitting above 6% all of the years, aside from 2012, where in fact it actually still posted a positive growth rate, but I'll mention that in a moment's time. If you look at the graph to the right, that indicates the Global Competitiveness Index score provided by the World Economic Forum, you can see that the Ivory Coast, denoted by that black line, again, in the last few years, has posted a stronger competitiveness score than your average sub-Saharan Africa countries and above that of the sort of average frontier markets. Nolan, if you can pass the next slide, please. So that then sort of begs the question is, how did the Ivory Coast respond to the pandemic? And what you can see is that if you look at the graph to your left, that indicates a stringency index created by the University of Oxford, which essentially is an index that indicates how stringent, how severe, or how strict really were the measures that a respective country put in place to deal with the pandemic. And these measures range. We're looking at issues such as school closures, workplace closures, travel bans, etc. And what the graph does indicate that if you look back at when COVID first struck, so we're looking at January, February or so last year, that the Ivory Coast actually posted in some very, very strict or stringent measures quite early on. And then from there on outwards, they moderated it down to quite a low level to where we are now, October of 2021. As you can see, the measures that are still in place are far less stringent than that of its regional peers. So, it's these rapid containment measures and the country's emergency health and economic package, which actually came to around 1.4% of GDP, that were really instrumental in minimizing the number of cases. Allowed for a reopening in mid-2020 already, which is far faster than the sub-Saharan African average, and in fact faster than quite a bit of the rest of the world as well. And this really allowed to contain the human and economic impact overall. So consequently, as a result, the Ivory Coast economy proved resilient in 2020. It still in fact hit a 2% growth rate in 2020, which ranks it among sub-Saharan Africa's best performing frontier market economies and a far better performing economy than a good few sort of in the rest of the world. And as a result of this, Ivory Coast was able to take advantage of these favorable market conditions and was the first sub-Saharan African country to return to international capital markets in November of last year. In fact, that particular Eurobond issuance was 5 times oversubscribed. They came back to the markets again in February, and that issuance was actually 3 times oversubscribed. So it just goes to show that the market really views Ivory Coast and Africa in general in a very sort of positive light in that sense. Nolan, if you could just go to the next slide, please. So that really leads to the point that I'm trying to make, where the Ivory Coast is sitting at the moment. If you consider the credit rating, so in this case, the graph in front of me, the Fitch credit rating, you can see that the Ivory Coast is actually rated at a BB minus, which puts it in line to South Africa, to put it into sort of a stark contrast rather. And in turn, Ivory Coast isn't actually the only other country within the African continent to post a stronger credit rating. Just off the top of my head, Benin, Morocco, Rwanda, they've actually all come through in the last while with strong credit ratings. So it's really indicative of the growth that we are seeing across the African continent. And really proves the resilience and the sort of strong investment opportunities that are available within these economies in particular.
So I'm just going to stick with this chart for a minute because I've had the opportunity to quickly look at the questions. There's a question on how likely are African countries to default, and the answer is firstly it's different for different countries. Morocco is a vastly different country to Gabon, for example, though actually I think both of those will probably be fine. In terms of African countries, what do we look at? How do we assess sovereign risk? How do we assess who's potentially going to get into trouble and who do we think will be okay? And there's a whole sort of rating metrics that we apply within Anchor, which is largely built off what the rating agencies do. But one of the key metrics for us is actually the trends that are developing. So, if you're starting from quite a low base, but you've got this constant gradual improvement every time we look at a country, the credit metrics are better, the dollar reserves are a little bit higher, the governance factors are slightly improving. That gives us a lot of comfort. And we do see a number of those countries that are on an improving trend in Africa at the moment. Casey mentioned the ones that got upgraded. Benin, I don't even know if it's on the chart in front of me, was a country got upgraded. Morocco's been upgraded, South Africa, Ivory Coast been upgraded, etc. And from that perspective, you're actually seeing positive credit developments, which says that the countries are moving in the right direction. The risk of default on those, in our mind, is actually relatively low, and from that perspective, we're comfortable. But equally, there will be countries that we are worried about. Two countries that have defaulted in Africa recently that did have Eurobonds. The first was Mozambique. It actually defaulted, I'd say about 4 years ago off the top of my head. But the issue with Mozambique is it defaulted because of government corruption and collusion with Credit Suisse as a bank. And what is interesting about that case is the court cases, the criminal cases against those involved keep going on. I saw the other day headlines about the bankers at Credit Suisse now facing the courts in the USA. Interestingly, if you cast your mind back about 2 years ago, about a year and a half, 2 years ago, there was a big thing about South Africa having arrested the finance minister. And there was a debate about would we extradite him to America or would we extradite him back to Mozambique? And it all had to do with, in fact, the corruption that resulted in the default. Very much is something that can happen. As for Mozambique, we owned none of it at the time of default. We've got a bit of a credit overlay on Mozambique, and we hadn't owned it for something like a year and a half, 2 years before it, before it defaulted. The more recent example is Zambia, which defaulted less than a year ago, and that was primarily as a function of complete mismanagement of the economy, complete mismanagement of government finances, and plenty of corruption. And that's also one where it's a bit of a slow-moving train, so we kind of saw it coming. We haven't owned Zambian bonds for 4 years, I think. But, it's another example of what can go wrong. And it was pretty much corruption and economic mismanagement run amok. Interestingly, the cost of that default seems to be quite low at this stage because the bonds are pricing in a very high recovery rate. It's not something we're participating in, but obviously we're watching it closely to see how it unfolds, because there are always things you can learn from events like Zambia. In terms of Africa, there are, who else we're going to got a closer eye on. I think it's going to be fine, but we are watching Kenya mainly because it is accumulating a lot of debt, and that's always a little disconcerting. However, the government seems to be able to manage it. The other potential hotspots are probably more political in nature, Tunisia and Ethiopia, where you've got significant political developments that are, hampering the countries. Got to be aware of those, got to be in tune with those. We do monitor them, we do discuss them. In reaction to that, we've significantly reduced our exposure to both countries. We haven't fully exited yet, to be fair. But we do have a watch list, much as you would in South Africa. I think, if you're invested in domestic South African fixed income, you've also got potential credit risks. You've also got, potential defaults that you've got to be aware of. And, they will arise from time to time. What is important in managing defaults, just before we move on, and I'm maybe harping on a bit here because I did see a question on this, is that you can analyze a company into the ground. You can analyze a country into the ground. At the end of the day, a number of people analyzed something like Steinhoff, and they didn't see the fraud. I didn't see the fraud. We happened, by the way, not to own Steinhoff bonds, but for different reasons. That means that you can't just analyze a country. You've also got to have a second layer of defense, and that second layer of defense is diversification. So the perspective we take is on a lot of these countries that are potentially worrying. Angola's less than 1% of our portfolio. So if something does go wrong in Angola, in Ethiopia, whatever, we've actually taken such a small exposure by being able to diversify across Africa, that a lot of those countries, it's a minor flesh wound. It's something I'm going to be quite sad about. But the portfolios that invest in African income should be designed such that you've actually got maximum diversification to protect you. And that's a key mainstay of our and other fixed income portfolios that invest in Africa. So, default risk in many cases probably less than that of South Africa. And whereas more than South Africa, just make sure that you're adequately diversified. But if we were to now really look at Africa and we say, well, we do have these countries. There's clearly some risk in these countries. Let's see how we can invest with some safety factors, because we want safety factors in what we invest in. And the first safety factor that we have to be cognizant of is the fact that we're investing in US dollar denominated debt. Very, very important. And that I've already mentioned that the portfolio faces no domestic currency risk. So I was reading yesterday that Nigeria is probably going to need to devalue its naira again. They've run a peg currency. That naira devaluation is going to hurt anyone who owns domestic Nigerian investments. However, the fact that we are in hard currency assets just takes that risk away from us. We don't want those risks. You want to minimize your risks in Africa and design a portfolio that achieves that. The portfolio also has no risk of currency or capital controls anywhere in Africa. And that's probably one of the most important factors, because this is what hurt a lot of our equity investors, was finding out that, once you've invested in Nigeria, getting your money out is a bleeding nightmare. And we just don't have those risks. The portfolio is not subject to the risk of being in a long queue to get out of the country. But one of the other very important factors for us is, can you imagine trying to sue the Nigerian government in Nigeria if it doesn't pay you? It's just a disaster. Don't want to think about it. So big advantage to all our investments is they are actually subject to the laws of England, New York, Ireland, some of them in Luxembourg or other reputable jurisdictions. And that means that, we don't have that local risk of law, that sort of risk of corruption within the legal system. And it means that our claims against these countries are actually legally enforceable. But what does that mean? What does legal enforceability mean in Africa? I mean, if Nigeria turns around and says, I'm not going to pay you, what can you realistically do? Well, actually, Argentina did that. They turned around and said, we're not going to pay you. And it was under bonds that were documented under New York law. So a bunch of recovery funds sort of bought up the bonds, went to the courts in New York, and the bonds were held to be enforceable. Consequently, what happened is these funds now had an ability to start chasing Argentina. So what they would do is, basically try and sort of put blocks on the country's foreign bank accounts. There was a massive situation where one of the Argentine ships, it was a vessel delivering goods, went to Ghana, and the hedge funds basically obtained a sort of court order to seize the government's ships out in the Ghanaian port. So this poor ship got stuck in Accra for something like a year while this was all dealt with. And it became, and these funds kind of hounded Argentina to the extent that Argentina eventually turned around and said, you know what, our bad, yes, this is enforceable, we're going to pay. So, the point to make is that guys have tried to run from these debts before, but it just didn't work. And there's an increasing realization that these are genuinely commitments that you need to take quite seriously. And a consequence of this is it actually is increasingly making countries reluctant to default on these debt. And we continue to see countries like Venezuela that really can't afford it, but it's going to service these Euro bonds because it doesn't want the problems that come with failures. And in fact, at the time of COVID crisis, there was a lot of pressure on many of the governments. The IMF was getting involved, the World Bank was getting involved, and they were putting pressure on countries to defer payments. They were putting pressure on countries to sort of shore up their foreign reserves, negotiating extended or delays to settlements on debt maturities, etc. They went to the Chinese and they negotiated that many of the loans from China, the Chinese government into Africa would be delayed. Many of the aid agency developments would be delayed. But what was very interesting was actually that the finance minister of Nigeria turned around and said, look, got to understand, we can talk to the bilateral, aid agencies and other governments who lent us money. We can't do that to the bond market. And we've got to treat the bond market with respect because we need access to the bond market in future. And I think that statement from the Nigerians was very telling, where they said, these are the debt instruments that they just have to continue to service, because they don't want to upset the apple cart, because in the long run, they know that they're going to need to tap the markets for further financing from time to time. So that in itself gives a great gravitas to this debt, and it actually gives a great degree of confidence that the governments are very serious about maintaining a good relationship with the debt markets. In terms of liquidity, I've already mentioned that the global bond market that these bonds trade in is actually the single largest financial asset market in the world, traded in multiple jurisdictions, multiple exchanges. And the result is actually that the liquidity we see in this asset class gives us a massive ability to manage the asset class, to change positions, to shift. And that means that, you've got far greater ability to exit positions when you need to. Give you an example. I mentioned Mozambique earlier, and Mozambique basically lied when it issued the bonds. I bought some of the bonds. I think the story we were told was quite compelling. The due diligence looked good. So bought some of the bonds, not a tremendous amount of the bonds. But about a year and a half after that, Mozambique one day basically put out a press statement that said, "How bad, we lied to you, sorry." Immediately, that's a red flag to me. I'm looking for someone I can trust that I lend money to. So sold those bonds that day. No problem. The country just put out this horrific news. We sold the bonds, sold them in a matter of minutes. Market's deep, it's liquid. What's even more interesting is if you look at the trade prices, we managed to sell those bonds at a profit. And, that's just the nature of the global bond market. It's got the liquidity to allow that. And at the same time, the flexibility that you can, that the pricing is reasonable at any point in time. But the other big counter, and it's definitely a differentiator within the world, is the IMF. So the International Monetary Fund sort of acts as big daddy behind the scenes for a lot of these governments. And, from time to time, you don't have all the technical expertise in Africa that you might have in other developed markets. And the governments lean on the IMF for advice. And frankly, they also lean on the IMF for funding from time to time. The thing is that the IMF tends to come in as a lender of last resort when these countries are in trouble. Most recently, we saw this in Angola, and I've got a lot of sympathy for Angola, actually. They really were unlucky with COVID. But, they'd actually got their government finances from a position where corruption had caused a problem. They'd actually brought them to a manageable position. So they had the reasonable debt to GDP ratio. Their debt was starting to look affordable. The whole country was coming right, and then COVID hit, lockdowns hit, oil price dropped, and poor Angola kind of found itself in a situation where it now accumulated that additional 10% debt that all the countries accumulated. Revenues dropped off a cliff because the oil price was at $20 a barrel, and Angola's hard-won success was kind of thrown away overnight, and they were back in trouble. They turned to the IMF a second time around. They've undergone a second IMF program, painful, but you can actually see the Angolan finances improving. The market has reacted very warmly to it, and it's a success story for the IMF, and the government in fact in Africa. The IMF has actually been quite active in Egypt. A couple of years ago, Egypt was in a spot of bother, and the IMF worked with them basically to sort of unpeg the Egyptian pound and to allow it to float as a floating currency. And it's had massive positive spin-offs for the country. Obviously, the adjustment was quite stark. It resulted in rampant inflation for about a year. But we've seen, you've seen significant success. And actually, these days it's not uncommon to see articles suggesting that Egypt is one of the countries of the future in Africa, and pointing to, how well they are doing. And it's just their ability to sort of tie up with the IMF. So it has worked very well in many cases. But more importantly, when the countries are adjusting, the IMF also gives them additional financing, bridging financing, which kind of comes in as a lender of last resort. And it's allowed countries like Angola, like Egypt, etc., to actually continue to service their debts, to continue to pay back their bondholders at a time that they are taking necessary and sort of painful adjustments. So from that perspective, we're buying assets that themselves are pretty, are reasonably robust, but then you've got Big Daddy looking over their shoulder, looking to protect you as well. And that's actually a lovely place to be. But finally, because I see my time is slowly winding up down here, let's talk about African income and what do you really get? So I'm talking here, Anchor has a specific nuance on how we look at African income. So you need to think of it as a rand denominated investment. And whoops, this is the chart showing you our performance since inception over time. And the first point on this chart is optically, it's not a dead straight line. It's not a money market fund, but it's also not an equity line. And therefore, what you really are seeing is a fixed income-esque behavior over time. And that's kind of what you're looking for. So you are getting fixed income risk over time in Africa. Secondly, I point out that what we do is we currency hedge a lot of the dollars back into rand, so you don't get a pure dollar exposure. You kind of get a half rand, half dollar exposure. We do that for sort of specific technical reasons, but what it does doing that is it obviously softens volatility, so your portfolio is a lot more stable over time. But you still pick up rand dollar exposure. And at periods where the portfolio has actually underperformed, what it really has been is that the periods where the rand has strengthened. So you end up with a bit of rand dollar exposure, you're buying dollar denominated assets, and it's that rand dollar exchange rate that has actually hurt you over periods of underperformance, with the exception of the sort of global risk sell-off at the time of COVID. But from that perspective, how should we really think about the portfolio? And the first point I'd make is think of it as a diversified portfolio with less risk than the name suggests. So don't see Africa and run a million miles. Just look at what's actually in there. Look at the risk factors you're really running. It is something that's actually reasonable, and sort of I've got some of my own pension money in there, I guess. The second point is ultimately, what is it going to do for investors? How should we really think about it? And it is a portfolio that is rand denominated. It's going to give you a yield of about 7.5% in rand over time. It's got a reasonably low duration, so duration circa 4 or 5 years, which means that you should expect to earn on average 7.5% per annum over time in rand. Plus, because of that currency exposure, it gives you an additional kicker every time the rand weakens. So at the moment, the rand is going down the toilet, something to do with load shedding. And this is the type of income portfolio that just sort of softens the blow from domestic assets coming under pressure, because this portfolio is getting that kicker from the rand. So that's what it is. That's what it does. I do think, and I do say to people, that there is a bit of exposure space for this in portfolios. Don't buy 100% Africa. I think that is absolute insanity, but zero is probably the wrong number. Sitting there over the next year, as we look at returns and we go, it's difficult to make returns. What can I do to just add that little bit of extra pizzazz to a client? Africa is something it's definitely worth thinking about. I'm going to stop there and turn on to my camera, ask Casey to join me, and just open up if there are any questions. Dale, I trust you to run with that.
Thank you very much, Nolan and Casey. It was insightful as always. Everybody, you can type your questions into the Q&A now. We do have a few mailed in questions that were sent to us before this. So first question is that if this is a dollar priced asset, how does that affect Regulation 28? And if it is part of my offshore allowance, is it a good proxy instead of offshore cash?
Okay, so there are two questions there. Regulation 28, so we're talking about, it's not unit trust regulations, it's pension fund regulations. And specifically, we're talking about the rules that govern maximum exposures to different asset classes. Regulation 28, incidentally, we're expecting a revised draft of Regulation 28 from National Treasury shortly, primarily to permit infrastructure assets. However, for the purposes of Africa, Regulation 28 allows up to 10% of a pension fund to invest in Africa over and above the allowance for offshore assets. So if you want to, you could theoretically take 30% of your offshore assets and buy stocks in America, and you can buy an additional 10% exposure of African dollar assets, which is really what this is, using the Regulation 28 allowance for Africa. Incidentally, if you wanted, you could apply your whole 40% allowance to Africa as well, but that's just crazy. Don't do that. I think a far lesser number is appropriate.
And Nolan, the second part of the question, whether this would be a better option than offshore cash?
It depends. I think circumstances are different. In terms of offshore cash, if you are holding it as cash because you can afford zero risk, you need it to pay your kids' schools, university fees or something. I'd say cash is probably a better proxy for that. African income is a risk asset. I think it's a lower risk asset, but it's certainly not a zero risk asset. And we should view it in that construct. So, on the spectrum where you've got your go-go growth equities, as the most risky, your cash as the least risky. African income, I think, is towards the lower end of the spectrum. Certainly, it's the portfolio, as I've described it, as we designed it, is designed to be towards the lower end of the spectrum. And you should see it in that light as you would domestic flexible income portfolios, for example.
Thank you, Nolan. I think this is for Casey, and Nolan, jump in if I'm wrong. Just the view of the local elections on Monday, and what sort of results and what results would affect the bond market, or does it not matter?
Nolan, are you happy for me to take this one? You can jump in after if you feel that I missed anything. All right, I'll take that as a yes. So yeah, of course, going into local election obviously holds far less risk factors than we would at a national election. But these local elections on Monday are, of course, one of probably the hottest contested bouts of elections we've had in a long time. The truth of the matter is that whether you look at our two sort of leading parties, whether it's the ANC or the DA, in general, the electorate as a whole is not happy with our leading political parties at the moment. And that is where some of the key risks are coming from. So we're going to have a case of a lot of voter apathy, where a lot of voters are just not interested in coming through to the voting cycle. They're just going to stay at home. Or they're going to start voting for a lot of smaller fringe parties. We have the likes of Action SA, for instance, with Herman Mashaba. Of course, we have the ever vocal EFF. And that's really where the risk comes through, because now we start looking at, for some of our key sort of municipalities, that we might end up having cases of coalitions. And traditionally, coalitions have always been bad or even worse for service delivery outcomes. And that is where we sort of view a lot of the key risks coming forward. And I believe that is also where a lot of the bond market would be sort of pricing the risk in. It will be more sort of the outcome of the elections. And if we do have a lot of the cases of these fringe parties coming to play and more coalition municipalities, I think that's really where the key risk factors are sitting at the moment. Nolan, I'm not sure if there's anything you want to add on to that.
Not a heck of a lot. I think that from a financial markets perspective, local elections have tended not to matter. It's not something that's historically moved the market much. And absent a big shock, I think that's the case. The market is expecting a sort of continuity of policy, a continuity of leadership in the country. So, a wild scenario where the ANC gets 10% of the vote or something crazy would create a bit of a surprise factor, to put it mildly. But any normal realistic outcome, probably broadly similar to what we saw in 2016. I don't think the market's really likely to respond negatively or positively. I think it's more of a local governance issue, this one.
Nolan, question for you. What is your view on SA bonds going forward in a global equity risk-on scenario?
That depends a bit on the nature of the global equity risk-on scenario. I think the most likely scenario that I see is one where global economic growth is going to slow. Next year, we're talking about the USA's economic growth slowing from 5% to about 1.5% by the end of next year. That's a massive deceleration. To the extent that the risk on is a function of, the US is tapering its bond purchases, inflation is coming down like we expect it will, it becomes a bit of a benign environment. That's a Goldilocks environment for SA bonds as well. And just like other risk assets, SA bonds will prosper. In a global environment where equities are doing well, but that's because inflation is sky high and it's kind of the only inflation hedge you can use, that creates a very different outcome. That's quite an extreme view. I know a number of people do talk about US stagflation, high inflation rates, etc. It's not our base case by any stretch. I think that the inflation we're seeing is transitory, which basically means that US PCE, which is the key inflation metric the Fed looks at, going to be about 4.25% at the end of this year, and we expect that that'll trickle downwards to like 2.25% by the end of next year, which is a benign inflation environment. So, most likely an environment that's good for global equities is good for global risk assets. It's good for South African domestic bonds. It's actually good for African income as well.
Thank you. Casey, question for you. We see that our finance minister has delayed his budget by a week. Is this something that we should be worried about, or is this unusual?
Not the first question I've had on this, and probably not the last either. So I believe it's a bit of a case of a 50-50. There is about 50% of the true reason being that they have got the local elections on at the moment, and that will be sort of delaying a lot of the key officials. But secondly, it is likely that there are some difficult conversations being had on the background. There is a lot of pressure sitting on expenditure at the moment. We're seen our finance minister having to fight those sort of elements within the party. And in a sense, I actually view that as a positive. If it was a one-way rhetoric, then we wouldn't sort of have these postponements. But the fact that it has been postponed and that perhaps these difficult conversations are being had is a positive. That means that there is sort of some stance there that the finance minister is possibly standing his ground on trying to keep expenditure contained, which is sort of the real key issue for our office environment at the moment. So I would say more of a sort of a neutral event at the moment. If it was a long postponement, perhaps more of an issue, but it is just by a week. We do have the local elections coming through at the moment, aside from our rolling blackouts as well. So it's a 50-50 case. I view it actually as a more positive situation.
Thank you, Casey. Nolan, emailed question for you. When managing a pensioner's income, with interest rates in South Africa being virtually at all-time lows, how much Africa income would you include as a yield diversifier, as a percentage in a portfolio?
My perspective on African income is it is a fantastic diversifier, but don't get too excited about it. I actually had another fund that had 10% exposure to African income. I phoned them up and said, guys, just put the brakes on you. Honestly, I think between 2.5% and 5% is the right number. I think that it provides a little bit of a yield kicker, it provides a bit of an uplift, it provides a bit of a buffer for South African bonds in the short term. But it's also got to be enough that, it's meaningful enough that you do get some benefit from it. A 0.25% is just pointless. So 2.5 to 5 is right. I think more than that, you start to take a bit of idiosyncratic risk. I mean, you don't want to be too exposed to any particular single risk factor or portfolio. So that's my perspective.
Nolan, would you echo that view in a normal balanced portfolio?
Absolutely, I would, yes, without hesitation.
Okay, guys, I think that covers questions for today. Thank you very, very much for attending. And we will see you at the next Essentials. Goodbye, everybody.